Right. So, family, before we start the session today, let's celebrate the birth anniversary of Yashvir Bhai Sahab. An amazing man, the senior most Gen 2 in our clan, his father, the senior most in Gen 1, and his son, the senior most in Gen 3. Bhai Sahab was the quintessential gentleman of the family, a great achiever with great humility, the best kind, a real family man, a man with unshakable principles. I have many happy memories of spending time with Bhai Sahab from when I was 5 years old till about 2 years ago when we all got together in Lucknow to celebrate his birthday. Happy birthday, Bhai Sahab, from this entire clan. So, money, money, money. I, I've had many problems with money, so I'm going to talk about what problems I've had, okay? Uh, I thought I knew money, but I apparently didn't. So I had some money sometimes and I didn't have some money sometimes. I am quite an expenditure expert, actually. I know how to spend money. This is a genetic trait that was passed down from my father to me, and I think I've passed it down to my son as well. So all three of us were great expenditure experts. My first real entanglement with money was in the late 1971 in my first interview. By the way, I've had only 3 interviews in my life, of which 2 were successful and 1 was a failure. I'm going to talk about the failed one, the failed interview. So this was DCM, senior management trainee, which was, I think, one of the only 3 or 4 big jobs in the private sector that you could get. And there were 2 of us who were actually confirmed for the job. And Mr. Bharat Ram, the chairman of DCM, wanted to meet us both. So and this was meant to be a 20-minute meeting. And I walked into the room and I was asked to sit down. And then he looked at me and said, "Young man, do you read papers?" "Yes, sir, I do." "So what have you been reading lately?" And, cut here, I could have spoken about movies, I could have spoken about cricket, I could have spoken about impending Bangladesh war at that point in time. No, 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 no. I spoke about Bretton Woods. Okay, so Bretton Woods was a world finance money system that collapsed that year. And so, Mr. Bharatram woke up all of a sudden, wide-eyed. He smiled at me. "Oh, that's a great topic. So let me hear what you have to say about Bretton Woods." And I launched forth, having just left St. Stephen's and thinking that the world belonged to me. I launched forth in my theories on Bretton Woods and how damaging it was and this, that, the other. Bharatram was a great listener. He listened to me for 15 minutes and then asked me a 1-sentence question. And then I went on for another 10 minutes. And then he asked me another 1 sentence. This was meant to be a 20-minute meeting. It went on for 2 hours. And at the end of the 2 hours, just in asking me 1-sentence questions very frequently, he destroyed me and I collapsed on the floor, completely destroyed my argument. And needless to say, I didn't get the job. So that was a very valuable lesson in my life. Do not speak about anything in front of people who know about something that you don't really know. And I didn't know about money at that time. And I went to Africa from London, and I went to Nigeria, and that was a cash economy. So we were part of a large group, and there were bags and bags of cash that used to come into the cash office every single day. Not $10,000, not $100,000, $1 million, $2 million, $3 million, every single day. Hadn't seen that much money in my life. And there was this peculiar system that, you could not remit your salary overseas because the Central Bank of Nigeria used to take 3 years to remit your salary through the banking system. So we used to buy these little gold coins to spend our salaries on and then take them out of Nigeria. I built quite a nest egg, I think, by the mid-80s. In Nigeria, I used to bank with a bank in London called Bank of Credit and Commerce International. very famous bank. And that bank used to give us service like nobody else did. I never went to a teller, never went to a cash counter. I was always invited into a lounge, given coffee, and and they used to ask me, what do I want done? Do I want to transfer money here, there, how much? And it was done instantly. Well, that bank collapsed. And along with that, I lost my entire life's savings. And Deloitte was appointed as the receiver of that bank. And Deloitte decided, in their wisdom, that the depositors would get only £5,000 out of whatever they had, whether it was $100 million or it was just £6,000. They'd get back only £5,000, of which they took a commission of £1,500. So I got a royal sum back of £3,500. My life savings gone because unethical bank, unethical practices. Also in Africa at that time, the government decided that the currency was very weak. So they all of a sudden, like demonetization happened over here overnight, they revalued the currency by 400%. 400%, not devalued. And reversed it after 1 year, but in the meantime, they destroyed the entire economy, which went down the toilet. Interest rates in those days were 15% per month. Inflation was nearly 200% a year. Long-term debt was 30 days. And this was the chaos that intervention in the money system created and destroyed the economy completely. I went to Brazil for a holiday, and I went into a shop and I asked the price, and they told me the dollars. I said, okay, I will come back because it was a slightly expensive item. I said, I'll come back tomorrow to let you know. They said, well, tomorrow the price would be at least 10 or 15% more. This was the level of inflation that was happening in Brazil at that time. This was also in the mid-80s. So 10%, 15% inflation per day. Then, of course, I went through the financial meltdowns of 97 and 2008 and saw how banks and central banks and regulators and young fellows on Wall Street just collaborated and created complex financial instruments and derivatives and just went crazy, absolutely. And they caused these 2 or 3 crises that I went through personally. It was crazy that you could actually buy a home with just 1% equity in it. And there would be a line of bankers that would lend you 99% of your home value to buy that home. So this was just the complete Ponzi schemes and collaborative effort between governments and bankers and Wall Street and regulators. And then, of course, came along a very fictional character, a Japanese character who nobody has actually ever met. And he created a coin that he called Bitcoin, and you're supposed to go and mine it from somewhere in the deep crust of the earth through a very powerful computer and power source. And, well, I'm sure 1 or 2 people in this session will talk about what all that is about. And then, of course, we had this demonetization at 8 p.m., which I will not talk too much about, but that also disrupted our economy quite a bit. Experiments, adventures, conmen, suckers, Ponzi schemes, failure of governments and regulators and banks, seen them all in my 50 years of working life. What next? So let's get the answers from these 5 wise men from the family who will talk about money, money, money. And these people are Vishu is the first central banker of our family and retired as an executive director, RBI, where he worked in important functional areas. He also served on several important committees and working groups of government, RBI, and international bodies, and RBI's nominee director on the boards of certain major banks and financial institutions in the public sector. After retirement, he is engaged as an independent director of some prominent companies, as an arbitrator, and as a consultant. Vishu graduated from Allahabad University, MBA from Jamnalal Bajaj Institute of Management Studies in Mumbai. Uday is the regional director for Asia, Pacific, and Europe, an assistant director, and the IMF mission chief for the United Kingdom. He has led missions to many countries across the world. Uday has held various positions at the IMF and the Reserve Bank of India before that. He has been closely associated with several international level initiatives stemming from the 1997 Asian crisis and the 2008 global financial crisis and the 2020 COVID-19 pandemic crisis. He has published books and papers, and his current work interests include the study of institutions, optimal policy mix, and on the macro financial aspects of climate change and financial technology. Amar is Deputy Manager, General Manager with the RBI. He represents the RBI on various external committees. Within the RBI, he has worked in banking supervision, financial markets, licensing of new banks, and registration of NBFCs, as well as doing a stint with the Central Bank of Oman. Amar is a qualified chartered accountant. Before joining the RBI, he did his articles in KPMG, worked with Standard Chartered Bank and IDFC. He is a graduate of St. Stephen's College, a chartered financial analyst from the CFA Institute USA, a GARP certified financial risk manager, and a certified associate of the Indian Institute of Banking and Finance. He has certifications from ACCA and GARP in international financial reporting and in banking risk and regulation. Deepan is Managing Director, Regional Head of Transaction Banking, Asia and Middle East and Commerce Bank. He is responsible for payments, cash management, trade and supply chain finance across Asia and the Middle East for Commerce Bank. Previously, Deepan was with ANZ, with Standard Chartered, with Bain, Solomon Smith Barney, and with UBS Warburg. He has led frontline teams covering correspondent banking with large financial institution partners, multinational regional treasury centers and commodity traders in Singapore, procurement and distribution hubs in Hong Kong and Dubai, and large manufacturing exporters in China and Japan. He has published several articles on trade finance. Deepan graduated with MA Honors in Politics, Philosophy and Economics, PPE, from Oxford University, and holds a master's degree in business administration from INSEAD Paris. Ankur has been working in the technology sector for almost 2 decades. He started with tech in the banking sector, joined a startup in digital media, now in the corporate sector, focusing on experience, design, and digital transformation in retail and consumer services with Zensa Foolproof. He advises startups. An early experiment involved launching a novel cryptocurrency with the objective of battling fake news and solving the monetization challenge that the media industry faces today. Today, as an advisor, his key involvement is with a startup called Awake, which is focused on harnessing the power of social commerce, which has a massive global opportunity, and are running pilots in India, US, UK, Brazil, and South Africa. Ankur has also co-produced a book for children titled The Kittens Who Would Not Meow. These are very appropriate speakers to speak about some of the problems that I've had with money, and money. So over to you, Vishu, the leader of today's session.
Okay. Well, good evening, family, and thanks for your introductions, Ranu, and your kind words. I must compliment you for your stellar role in carrying forward Chachaji's vision of turning our family into a knowledge family and conducting these FDG sessions, which have been all absolutely enthralling. And we do hope that today's session, Money, will also be enriching, at least knowledge-wise, if not money-wise. So sorry to disappoint you, folks. This is not about making money, but this is about money. The title of today's session was inspired by the ABBA song, Money, As the song goes, money, it's always funny in the rich man's world. But while money and funny do rhyme, and having a lot of money could indeed be fun, money is actually a rather serious subject that plays a critical role in our lives. It can make us happy, but having too much or lack of it can also be a cause of discomfort or sadness. As Ranu, you might have felt when your bank failed or you lost the money that you were talking about. It may therefore be worthwhile to know more about money, its history, intricacies, how it is issued and regulated, and what is currently happening in the world of money. Our session today is an attempt to cut the clutter, as Shekhar Gupta would say, or demystify money for you. We are all familiar with it, undoubtedly. We have studied money also in our universities and colleges. But the subject is getting more and more complex, fascinating, and interesting by the day. So what is money? At the risk of being cliched, let me cite the well-known couplet. Money is a matter of functions for a medium, a measure, a standard, a store. Money, as you would surely know, performs four basic functions: generally accepted medium of exchange for goods and services, store of value, unit of account, and a standard of deferred payment. But for money to be money, it is of paramount importance that it should enjoy faith and confidence of the public. It's for nothing that the governor of Reserve Bank signs a banknote and the central government guarantees it. These promises and guarantees instill a lot of faith in public on their currency. Therefore, anything that we wish to call money has to meet these criteria. And above all, money to be money has to enjoy public confidence and faith. I reiterate. I should also clarify here that though many of us tend to associate money with cash or currency, it is only a part of the equation. The predominant component of money is actually the deposits that banks hold and that banks place with the RBI or central banks. Cash and bank deposits constitute overall money supply in which the cash component is hardly 14 to 15%. Money's evolutionary history has been fascinating, and it has been conjured in many different forms. It has been issued and controlled privately or by sovereigns in different stages of its history. Presently, money is issued and controlled by central banks as a fiat currency with full sovereign backing. Money is now being reimagined and issued in digital form, virtual money. At one end, there are the local currencies, and on the other end of the spectrum, one is witnessing the rise of cryptocurrencies, such as bitcoins, which recognize no borders and are free from sovereign or regulatory control. Whether cryptos can be termed as money or just as an asset, and whether governments should allow them, is a contentious issue that is under the spotlight, and every day you'll be reading about it in the newspapers with statements coming from the governor, RBI, from the finance minister, from various officials of the Ministry of Finance. But sometimes these statements are very conflicting, and there is a bit of confusion here. Certain central banks, as Uday would tell you, have perhaps in response launched or are in the process of launching their own central bank digital currencies. Like you can have an e-rupee also. India is also thinking of doing that. And this e-currency will have full sovereign backing and enjoy legal tender status, which the cryptos so far don't have. So next time you visit the famous Trevi fountain in Rome, don't forget to toss over your shoulder 3 bitcoins in the fountain and sing 3 bitcoins in the fountain, each one seeking happiness. Now that'll of course require some courage and a large heart too, because bitcoins cost a bomb. But don't worry, bitcoins are only virtual, residing somewhere in the clouds. We cannot discuss money meaningfully without dwelling on the role of central banks, whose dharma it is to ensure monetary stability, which essentially means stability in the value of the domestic currency, both internal as well as external. But stability has other important dimensions as well. And this is brought out very succinctly in the RBI's latest report on currency and finance of 2020-21. I quote from the report: central banks stand for stability, price stability, exchange rate stability, financial stability, regime stability. These nuances of stability fill the lexicon of their vision and mission statements. Above all, it is regime shifts that draw forth their stiffest resistance. It is only tectonic change in their environment without or in their philosophy within, which can force them to make a step into the dark to a new regime. Central banks have to therefore act with considerable circumspection, prudence, caution, and proper understanding of the risks involved and their ability to properly manage them. In the words of a former governor of Reserve Bank, Dr. Subbarao, and I quote, "In the RBI, we try to learn from the best in the world, but adapt our learning to the demands and culture of a maturing and emerging economy. We need to be constantly pushing the envelope, be at the frontiers of domain knowledge, oftentimes reinvent it, but all the time remain sensitive to the core concerns of an emerging market economy, one which is still home to hundreds of millions of poor people," unquote. I see this as a very profound statement, which puts a central bank's approach to systemic changes in the right perspective. They would be wary of anything that is disruptive for the financial system or its integrity, always conscious of the larger public interest. So you could excuse them for their baby steps. But this is not to say that central banks are backward and anti-change. Many times, they are actually the drivers of change. For example, Reserve Bank of India has been the chief architect and catalyst in conceptualizing and operationalizing the state-of-the-art payment systems that you have in the country today. It has all along promoted adoption of banking technology that has led to a sea change in how banks run today, how currency is handled, how currency is managed. A lot of technology is actually doing that for us, and the Reserve Bank has been very instrumental in doing it. The Reserve Bank technology has also facilitated the scaling up of financial inclusion and banking outreach. Having set the tone for the session, I think I will now take a bow, and I will turn to the panelists. After they have spoken, we will engage them in a brief discussion. So with these words, we can now request Amar to take it forward from here. Thank you. Amar, over to you.
So good evening, family. I hope I'm audible. I'm audible? Great. Thank you, Gauri Didi. So what I'm going to do is I'm just going to switch off my video for a while, and I'm going to start sharing my screen because I've got a presentation on. So I'll just stop my video and you'll have a screen share just coming on. Let's hope this is. So I hope you can see this. It's on?
Yes.
Great. So I'll just stop my video for a minute, and that conserves some bandwidth. So I'm going to talk to you really about the origins of money and how it all really began. The thing is that we actually don't know, because we figured out money even before we could figure out how to write. Money, we figured out how to write around 5,000 years ago, but money in some form existed even before that. A lot of anthropologists think that this is perhaps, on account of that there could have been a barter system that was there. Now, barter would basically mean that a farmer might want fruits and another farmer might have chicken, and they might exchange it. But the problem that happens with a barter system is that you have this problem of double coincidence of wants. Somebody should be willing to exchange a cow for fruit, and how do you divide it? How do you sell half a cow? How do you divide cows? So this problem of double coincidence of wants was there with the barter system. A simple solution to overcome this was to find something that everyone found valuable and was willing to accept. And there enters the concept of commodity money. Now, commodity based money perhaps has been the longest used form of money. It derives its value from the underlying commodity itself. Over time, various commodities ranging from cowries to cigarettes have been some form of commodity money. Initially, agricultural produce such as wheat and barley were used in Mesopotamia. In fact, the Israeli currency, the shekel, its name is actually derived from a unit of weight of barley used in Sumer. But the problem with agricultural commodities is that they're all perishable. They're all susceptible to rotting. They could be infested by rodents, and they're difficult to transport. And what do you do when there's a famine? Nobody has any wheat. So we needed something more durable and something that's smaller. So you have, enter coins and precious metals. As the Bronze Age progressed, we got better with metallurgy and we developed standardized forms. The Chinese between 1045 BC and 256 BC designed their money in the shape of commonly used tools such as spades and knives to distinguish between denominations. However, the credit for the first coins is ascribed to the kingdom of Lydia in the 7th century BC. The first coins were made of a naturally occurring alloy of gold and silver. It's called electrum. And they mined this from the river Pactolus. We've all heard the story of King Midas, the one who touched his daughter and, she turned into gold. And Pactolus is really linked to that. The story goes that he prayed to the gods to reverse his gift, and Dionysus heard his prayer and told him to wash himself in the river Pactolus. And Pactolus itself, after that, turned to gold. The shores of the river turned to gold. So that's the story of Pactolus and gold. But why should gold be so important and relevant all these years? The fact is that it wasn't, because even a Lydian gold coin, no matter how small, may have been too valuable to exchange for a loaf of bread. So you needed something that was more worthwhile to use as a daily medium of exchange, and something that was perhaps far more worthless. So there enters our humble cowrie. And you know what? The name of this is Monitoria moneta. I didn't make up that name. That's the actual name of the species. The word cowrie has Sanskrit origins, but cowries have not been limited to India alone. They've been used in Australia, North America, China, and Africa. In fact, as late as 1850, you had cowrie shells, which were a medium of exchange in Timbuktu. Our governor from the Reserve Bank, he's from Orissa, and he signs notes. But his people, the Odias, revolted in 1817, called the Paika Bidroho, when the British East India Company banned the use of cowries. So how did we go now from gold and cowries to paper? We need to thank the Chinese for this. The Das family has a proclivity for music. They would like the idea that true paper money appeared during the Song dynasty in China in the 11th century. Before the use of notes, some Chinese merchants found carrying coins to be too heavy. Therefore, they deposited them with a trusted person against a receipt. As this gained popularity, the rulers of the Song dynasty realized that they were running out of copper to strike coins, and therefore entered the first fiat currency, the jiaozi, which were really promissory notes issued by the ruler to redeem them later for some object of value. Marco Polo took the story of Kublai Khan and paper currency back to medieval Europe in the 14th century, from where the concept was pioneered by Genoese merchants and later developed by London blacksmiths. The Chinese currency warned that counterfeiters would be decapitated. Well, we moved to some more subtler forms of security measures today. Indian banknotes have intricate patterns on Gandhiji's portrait. They have a security thread. They have a watermark, an optically variable ink, where the color of various parts, like for instance, the 2000 numeral and even the security thread, it changes. It has micro lettering, very, very minute lettering, which you can see under a magnifying glass, and a host of other security features that are disclosed to the public. Undisclosed to the public, there are also secondary and tertiary features that allow machines and experts to detect the counterfeiting. Banknotes are printed at 4 presses, 2 owned by the Reserve Bank and run by its subsidiary in Mysore and Salboni, 2 owned by the Government of India in Nasik and Devas. RBI does not issue the rupee 1 note. It's issued by the Government of India, and the currency note, it's a currency note actually, as opposed to a bank note banknotes are the ones that are issued by RBI, and currency notes are the ones that are issued by the government of India. And it's signed by the finance secretary. RBI also does not mint coins. These are minted by the government-owned Securities Printing and Minting Corporation in Mumbai, Kolkata, Hyderabad, and Noida. And we are very self-sufficient in note printing. We've not only printed notes for India, we've also printed notes for Nepal, Sri Lanka, Myanmar, and Bhutan. Now, somebody had asked, how does RBI, decide? So RBI places indents with presses and mints based on a projection that considers two aspects. One is, what is the expected increase in notes in circulation to meet the growing needs of the public? And the second aspect is, what is the need for replacing soiled or mutilated notes that are already in circulation? So the expected increase in circulation is estimated using statistical models that consider various factors, including GDP growth, inflation, interest rates, growth in digital payments, etc. And the replacement requirement really depends upon what we presume is the average life of bank notes. After these notes are printed, what typically happens is that they are dispatched to our 19 issue offices across the country. From these 19 issue offices, they land up in over 3,000 currency chests all across the country. These currency chests, with the money that is there is the Reserve Bank's money, but they're operated by the banks. And from the currency chests, they go off to the various bank branches. The bank branches also send back soil notes, and from the currency chests, the soil notes come back to the RBI, where we have currency verification and processing machines, CVPS as we call them, and they sort the notes into fit for reissuances, forged, and whatever is left after fit for reinsurances and forged notes, we've sort of shed them into briquettes, and these briquettes are sold to recyclers who convert it into pulp for use in soft boards. Our banknotes are made of cotton, so you can actually wash them, you can launder them, albeit gently. But if the Chinese gave us paper notes, it was the Australians who introduced polymer banknotes way back in 1988. And now several countries have shifted or are shifting to polymer notes, including Canada, United Kingdom, Singapore, and Mexico. But the problem with polymer notes is they're far more expensive to print. On the pro side, they allow more security features, and they last rather longer. I mean, they last 2 to 5 times longer than paper notes. So what is money? I guess you can say Puri Ramayan bata di, par Ram ke bare mein to bataya hi nahi. You can answer this question yourself actually. Suppose if I were to ask you how much money you have, in the narrowest sense, money would be the cash that's there in your wallet. In its broadest sense, it would not only include cash that is there in your wallet, but it would also include the cash that is there in your bank accounts. So this is akin to the concept of narrow money and broad money. Narrow money is the cash in your wallet, and broad money is both cash in your wallet or money in circulation, plus the money that is deposited in banks. But the essential thing is that whatever you call money, it must serve three essential functions. It should serve as a medium of exchange. Thanks to money, I don't need to exchange bread for butter anymore. It should serve as a unit of account that you can add up dissimilar things. So I can add up cows and inventory and plant and machinery, all in terms of a unit of money. It has to serve as a store of value. It means that the money that you earn today can be used tomorrow. I've sort of merged the fourth point that Papa had said about deferred credit into this thing being store of value. To my mind, that's linked to that. And a very interesting fact is, did you know that banks can actually create money out of thin air? So how do they do this magic? How do they create this magic? When you keep a deposit with a bank, the bank uses that deposit to lend money. What the loan that it gives, when it gives a loan to a borrower, it actually credits an account, thereby creating another deposit. That deposit can then become another loan, because you remember these are just book entries. As the thing is that money in the bank is also a deposit in the bank is also money. And money is not only cash, but money in the bank. So as long as all the depositors don't land up together to withdraw money, the bank is safe. And banks can keep on doing this entire process till infinity. They can do loan, deposit, loan, deposit, loan, deposit till infinity. But that's when the central bank sort of steps in and spoils their party with something known as a cash reserve ratio. So what is a cash reserve ratio? Well, for every in India, we have a CRR or cash reserve ratio of 3% right now. And basically means that for every 100 rupees of deposit, you need to go and a bank needs to go and deposit 3 rupees with the RBI. And that happens for every deposit. So if a bank if you give 100 rupee deposit to a bank, it deposits 3 rupees with the RBI and it has 97 left to lend. That 97 again becomes a deposit. Again, it needs to deposit 3 rupees. Again, it can lend whatever is 97% of 97. And then that again, it needs to deposit 3. So it can keep on doing it. But mathematically, it can be shown that it can do it only up till 1 divided by the CRR. In simple terms, it implies that a bank can now multiply rupees 100 of deposit only up to rupees 3,333 with a CRR of 3%. Before I conclude, I would just like to show you how notes in circulation are backed in India. So in India, the Reserve Bank of India Act 1934 requires us to back every note in circulation with assets such as gold, government securities, and foreign currency assets. As of June 30th, 2020, we had notes in circulation worth rupees 26 lakh crore, which was almost entirely backed by foreign currency assets, which were at 25 lakh crore, and a little bit with gold, which was around 1 lakh crore. Interestingly, you'll notice that the notes that we've put in circulation, we don't need to pay any interest on these notes. Whereas on all our foreign currency assets, we earn a return. Even if I assume a 1% return on these foreign currency assets, the 25 lakh crore translates into 25,000 crore. Minus the distribution costs, the government basically has a right to this profit, because it is a government that gives us this right to print notes. Without the government, our notes would be of no value. This is also a concept known as Seinorage, which basically translates from an old French into the right of the lord to mint money. Hence, you always have this constant debate and tension between the RBI and government over transfer of profits. But I guess that's for another FDG. Some people believe that all currency in circulation should be backed by gold, but that's not the case. In fact, no country in the world does that. And why is that? Assume you're sitting in the Narendra Modi Stadium watching a cricket match. How much gold do you think there would be if you could fill the stadium with gold? Well, the gold that you would have, if you were able to get all the gold in the world, it would just basically be a cube that would be the side of with the side of the length of the cricket pitch. That's the estimation of the World Gold Council. The World Gold Council says that, well, all the gold in the world could fit into a cube with a side of 21.7 meters. And that's, after knocking off 56,000 tons that's still underground. I mean, that's including that 56,000 tons that's underground. So fact is that we have a finite amount of gold, and no country in the world can afford to back its entire currency with gold. After the First World War, most countries went off the gold standard, and the United States, it had a gold exchange standard, and it went off with that with Bretton Woods, which Ranu Tauji was talking about in 1971. So now so all currencies across the world are really in a way fiat currencies, or most of them are. And what does that mean? That basically means that the government's decree that the money issued by the central bank or other authorities is legal tender. This means that legal tender means that it must be accepted by a lender if offered in payment, and it discharges the borrower from his debt or obligation when he offers it to a lender in payment. So this is what I had to say after explaining to you the functions of money, its origins, and shown you how rupees are backed by assets on the domestic side. I turn over to Dipan, who will talk to you about international money transfers and take it over from me. Thank you so much.
Okay, that's great. Thank you, Amar. If you could stop sharing your screen, then I'll...
Done.
That would be awesome. Oh, great, thank you. So good evening to many of you. Good morning to some of you, I guess. Welcome to the section on the movement of money. Now, what I will do is I will also share my screen, if I may. I hope you guys can see it there. The movement of money. Maybe someone can give me a thumbs up if they can see it. Great, thanks, Amar. Right, so what I'm going to start with is a bit of a story, if I may. And it's not a story from me, but it's a story which involves a former Indian cricket captain. So maybe you'll listen to him. He's a bit more interesting than me. I'll start with that, if I may.
माही तेरी फेवरेट पकौड़े की दुकान।
इतने दिनों के बाद आया हूँ, पर टेस्ट
वही का वही
है कि नहीं? अच्छा, मामी को मत बताना।
अभी भी डरते हो?
अरे बेटा, हर जगह कार्ड, ये 5 स्टार होटलों में जाना जरा कम करो। यहाँ पर आज भी कैश यानी कि नगद ही स्टार है। लो भाई,
थैंक यू।
कार्ड पे पकौड़ा
और ये चटनी भी। अब छुपाओ मामी से।
बचा ले बेटा।
27 लाख से ज्यादा दुकानों में चले ताकि इंडिया को पकौड़ों वाली खुशियां भी मिले। मास्टर कार्ड,
क्योंकि कुछ खुशियां हैं प्राइसलेस।
Okay, that's great. I hope you guys were able to hear that. So what was the story? Why did I show you a video clip with MS Dhoni? So what's happening is Dhoni and his mama were feeling a bit hungry and they decided to buy some pakoras. And what was going on there was really the second core money function, right? Money is a means of exchange, right? I think you've seen this graphic before from Amar's presentation, right? You used to have bartering, but now we've sort of moved on a bit and goods are exchanged for money. However, Dhoni and his mama had a very different approach, right? Dhoni's mama was trying to pay for the pakoras with cash, right? And Dhoni used a credit card. So look, these are just different ways of exchanging money between buyer and seller, right? The card is really just a medium. Cash is just a medium of exchange. And these aren't the only mediums of exchange. There are many actually, right? And just to relate it back to the things that you may be familiar with is money moves along payment rails, just like trains move along railway tracks. It's not that different. And there's many different tracks depending on where the money needs to get to, right? Domestically in India, for example, you have IMPS and UPI. These are the instant payment networks that are used for low value payments that a lot of customers would use, consumers would use, to transfer money to other accounts, to transfer money to each other and so forth. And there's also an RTGS network. I won't get into the details here, but this is more for high value payments, corporate to corporate payments that could be very significant in size, but maybe do not need to be as instant, right? And then there's cross-border rails as well. SWIFT is a network between banks by which banks exchange money with each other across the world. But SWIFT, although it is probably the oldest cross-border correspondent banking network, is not the only one, right? Ripple is a blockchain network that uses a cryptocurrency called XRP to transfer money around the world on behalf of money exchange companies, money transfer companies, a small number of banks even, right? And the card networks are increasingly active in this space as well. Whether it's MasterCard or Visa, they also themselves have cross-border networks that are used to move money around. So that's a little bit around the context of the movement of money. But I thought maybe we could indulge you with another video, if that's okay. And there's 4 characters in this video. There's a character called Money. There's a checkbook or a guy who's got traveler's checks in his wallet. There is a wallet. Remember, this movie's from 1979. So for this wallet, he only really has cash. It's not a digital wallet. And there's a guy called Mr. Card. So let's see what these 4 people do when they go on holiday.
Fancy getting lunch in, Fat Wallet?
I got cleaned out. I'm in the car.
Traveller's check?
I'll have to get changed first, dear boy. I'm British.
That's all right, Money. I've got it. It's much quicker with me.
I say, steady on.
And I'm accepted in over 4 million places worldwide. So whether you're peaking at China or just roaming through Italy, I can help you out.
They seem to be getting out of their depth.
Access, your flexible friend.
Right. So apologies. I know the sound wasn't great on that video, but it's from about 1979. So bear with me. But what's going on in this video here, right? You've got this character called Money, and he's got 3 friends: the checkbook, the wallet full of cash, and the card company. And they end the video by talking about flexibility, right? And really, when people ask, why is it that there's so many different ways of making a payment? You go into the Reliance supermarket, you could use your RuPay card, you could use MasterCard Visa, you could use cash, you could use Paytm. You could use a checkbook, but you probably wouldn't be expected anymore or accepted anymore. There's many things you can do to make that payment, right? And Paytm is not the only wallet. You also have Bharat Pay, you also have Phone Pay, etc., right? there are many ways that you can make a payment. If it was an online store, you could probably even use UPI or a real-time payment to make that payment. You could use a debit card. I mean, there's 100 different ways of paying, really, right? But some are more convenient than others. Some are more expensive than others. And some are quicker than others, right? So every one of these has their own pros and cons, right? So really, when we talk about the movement of money, we could sit here for hours, and the trends are manifold, right? It's the payment space really has been one of the most exciting fields of payments and banking, also of technology, and the intersection between banking and technology, right? But if I were to just step back, for me, there's 5 trends that I think in the last couple of years have really accelerated, right? Number one, the rise of domestic instant payment networks. So in India, for you, this is not new. For those of you who are in India or in the UK or in Europe or Australia, this has been around for some time, right? But in many parts of the world, it's actually quite new. So those countries that do not have domestic instant payment networks are rolling them out, right? Number two, cash was kind of dying, and in India was almost killed by demonetization, right? However, cash was still reasonably prevalent. However, COVID has really accelerated the kill of cash, right? And on the other side, you've seen cards, digital wallets, neobanks gaining further acceptance, right? Number three, I'll talk about a new thing that's really emerged in the last few years called the push payment on card rail networks, right? And that warrants a bit of an explanation in some detail. I'll talk about cross-border payments, which is really driven by migration, tourism, cross-border e-commerce, trade, exports, imports, right? And this cross-border payments is something that has a tremendous amount of pain, both for individuals and for companies as well. And I'll get into that. Very briefly, I'll talk about crypto, but I won't go into this in too much detail because Ankur, our expert, will also be covering that in his section, right? Instant payment network. So I hinted that India was really a forerunner on this, and India was actually. I mean, IMPS really has transformed the way the domestic Indian consumer payments landscape has evolved, right? IMPS has, and what that's really done is by having a real-time payments network locally, it's just made it a lot quicker for consumers to send money to each other, a lot cheaper. And really provide an ability to do so in a very secure environment, right? So that really is something that we've seen around the world, but there's still many countries that don't have strong domestic instant payment networks. For example, Indonesia does it, Vietnam does it. These are tenders that are out in the market right now, right? So this has been a massive change as well, right? And that allows you to use your bank account or your digital wallet or your neobank account to make instant payments to vendors, for example, right? Which otherwise you would have had to do using a card network, or you would have had to use cash or something like that, right? But beyond the speed and the transparency, there's other advantages as well. The payment can be made 24/7. You don't have to do it Monday to Friday, 9 a.m. to 5 p.m. anymore. You don't need to know the receiver's account number. You could just know their mobile number, right? And another trend that's happening is interoperability between instant payment networks. So Singapore and Thailand piloted something last year whereby you could make a cross-border payment from Singapore's fast network to PromptPay in Thailand. And I believe the Indian government and Singapore will soon be announcing a transaction where payment is going to go from Singapore to India, instant to instant payment network. Right? So imagine sending money from someone from one country to another instantly using only the domestic payment networks because they know how to talk to each other. Now, money going in the other direction, India to Singapore, is more complicated because obviously to send money out of India, you need a whole bunch of paperwork, right? Which is a lot harder to do electronically. Then I talked about how COVID killed cash. I mean, killing cash is a bit of a strong statement, but it's definitely inflicted some damage on the usage of cash and accelerated digital payment networks. This is some UK numbers in the Financial Times. 2010, 60% of payments in the UK made by cash, right? Around 2019, 2020, down to about 22% of payments in the UK made by cash. 2030, which is less than a decade from now, the FD expects it to be less than 10% of all payments in the UK being by cash. That's a rapid drop off in the usage of cash. India provides a very interesting example as well. I mean, blue over here is the card payment networks, which is mostly MasterCard, Visa, Amex, Discovery, right? Then you've got debit cards excluding RuPay, which a lot of them are actually done by the same credit card companies. RuPay on its own is a phenomenal achievement in terms of being an indigenous payment card network, really to rival the big two American ones, Visa and MasterCard. Then, of course, you have RuPay is the green. These are digital wallets generally, which in India are quite popular, and UPI-based payments as well, right? The rise of digital wallets in India has been quite phenomenal. I mean, Paytm was really an early mover, but Paytm no longer has the leading market share. I believe PhonePe and Google Pay now have actually a higher market share than Paytm. So that's been a rapidly moving space. And India now you have also have neobanks, right? Open, Instant Pay, RazorPayX. These are just examples where India hasn't explicitly given a license to these institutions, a banking license, in the same way the Singapore government has done recently. But they have allowed them to operate by leveraging the infrastructure of an existing bank, right? And for anyone who's opened a neobank account, I can show you that the number of times you have to click on your phone to make a payment, to open an account, to check your account balance, to send money to a friend, it can be quite amazing. Something that you can definitely try out. Card rails in reverse, and maybe let me explain this. This is the third big trend I wanted to talk about. So let's just start by giving an example. Suppose you walk into a restaurant, you have a nice meal, you want to pay for the restaurant, so you give your credit card to the waiter. What actually happens to that credit card? It gets swiped, right? Or you have contactless payments now and merchant terminal solutions. So you don't actually need to swipe, you just tap now, right? And money gets pulled from your account, right? I mean, I'm oversimplifying, but money basically gets pulled. The restaurant has a bank, that bank speaks to your bank that issued that card, and then that bank will pull the funds from your credit card account, right? So it's pulled. So this network exists from the two big card companies globally, right? And they process tens of thousands, hundreds of thousands transactions globally per second, right? So these networks have been developed over the last 5 to 6 decades, right? Now imagine taking the same processing network and using it in reverse, not to pull from your account as a consumer, but to give you the power to push. What do I mean? Rather than me just using that credit card to have someone pull money from my account, what if I use the same network to push money somewhere else? Suddenly, these rails become twice as useful. And let me give you a few use cases to help you visualize what I'm talking about. Suppose I want to transfer 100 rupees to a friend because we're splitting the bill for a coffee in 2. I could use that credit card network to push that friend 100 rupees, right? Suppose I have a salary that's paid to me on the 15th of every month. That's a reverse loan I'm giving my employer, right? I'm doing 15 days of work and I'm only getting paid for the month in the middle, right? That's 15 days where I've earned money, but I've not been paid money. So you have solutions in the US, for example, whereby you can have earned wage access. A lot of employers are offering their employees the ability to have that money pushed onto their debit card early for a small fee, right? What if you have an insurance company? You go see a doctor, you pay the doctor 1,000 rupees, you submit an insurance claim, the insurance company owes you 1,000 rupees, right? Normally, that money comes to you via check or it comes via bank transfer, which happens several weeks later, et cetera, et cetera. But why doesn't that money just get pushed onto your debit card? And from your debit card, it can stay there, it can go into your account, it can go into your Paytm wallet instantly the moment the insurance company approves the payment. And if you had an insurance company that offered this functionality, I can tell you a lot more of us would be using that insurance company because it's kind of nice to be paid straight away and then you just forget about it, right? So the use cases of these credit card networks to do what we call push payments has just grown rapidly around the world, not just for domestic payments, but also for cross-border payments, such as remittances, right? A worker wants to send $100 US home. can be done on the card network. And remember, card network doesn't mean he needs to physically have a credit card. In fact, the piece of plastic is meaningless in your credit card. That's just a form factor. What's of value is the 16-digit number, right? And that 16-digit number allows you to pay from card to card, card to account, card to wallet, or it could even help you pay from any of these, either from a bank account, from a card, from a wallet, using the card rails to an account, to a card, to a wallet. Complete interoperability, right? Now, I'm not going to say that you can do each of these combinations in every single country seamlessly today, but we are definitely actually moving towards that. And I believe this is something you will see in the next 2 to 3 years across all major markets as well, India included, right? Now, I talked a little bit about cross-border payments. Now, what is a cross-border payment? It's just money moving from one country to another. It's obviously a lot more complicated than moving money within a country because you're talking very often about different currencies. You're talking about different payment networks, right? However, these cross-border payments are the lifeblood of our global economy, right? More than 300 million people globally live outside the country of their birth and their childhood, right? That's global migration, and that number is only increasing, right? So a lot of these workers then want to send money home, right? We call it a P2B payment, a person-to-person payment, right? Or a remittance, right? Now, people may use banks, they may use money transfer companies, they may use these push payments that I just talked about. They could use Hawala, right? That's also a money payment network, so to speak, right? But very often the rails that are used in between are similar, whether it's Swift, whether it's Ripple, whether it's a card payment network, and so forth. It's often the same payment networks that are used by different sets of intermediaries here. Cross-border e-commerce. How many people have bought something from a website outside their own home country? You buy something from Amazon in the US, from Alibaba in China. You have it delivered to yourself. That's cross-border e-commerce, right? You're buying something from another country. So that's when it gets complicated with exchange rates, for example. Trade, imports and exports. Again, if you're exporting something to a country, that country has to pay you money. You're importing from a country, you have to pay that country money. That's a cross-border payment. Inside, investment, whether it's in shares or bonds or Bitcoin, or could even be a foreign direct investment for infrastructure. So anyway, let me help you visualize a P2P cross-border payments made by one of our heroes, or rather, should I say, to one of our heroes.
Come on, Chico, come on! जीतने में प्रॉमिस किया था ना?
Viju bhaiya, one day I'll play for the Indian cricket team. Promise. Chico, from that day I'll give you a rupee for every run that you'll make. Pakka? Promise, man.
Viju bhaiya, you never forget your promise, huh?
Chico, even if you score 1,000,000 runs, I'll still keep my promise. Send any amount from anywhere to India in just 3 clicks.
Remit to India. Promises come home.
Okay, so even Kohli needs money sent to him apparently from time to time. But in all seriousness, that was a story of Kohli and his childhood friend, obviously a fictitious story, or who knows, an arrangement they made where his friend would send him money, 1 rupee for every run that he ever makes, right? But this is an important example for a few reasons. Number one, India is the biggest receiving market for remittances globally, without exception, right? I mean, it is by some margin the biggest, right? And a lot of this is because the NRI population and the diaspora that sort of obviously spread out around the world, right? And this brings about some of the core issues of cross-border payments. Number one, it's expensive, right? Remember, a worker, your average worker who might work in a restaurant or, in the food and beverage industry or, on a construction site, or who's a driver or whatever, for your average worker, who's making $500-600 a month maximum, right? For the amount of payment that they send home every month, which could be $200, $300, right? The World Bank did a study last year whereby the average worker pays 8% of their money to remit that money home. So this, if they're sending $300 home, they're spending $24 on average to send that money home, right? 8% is a phenomenal amount of leakage, if you like, in that cross-border payment. Of course, for people who are sending higher values, the percentage drops, right? But for low value payments, this is a massive pain point. That not only for financial inclusion reasons, but also for competitive reasons, is something that's been attacked quite aggressively. Which is why if you look at Western Union, Remitly, TransferWise, Revolut, I mean, these are all cross-border payment companies, some of which have really started to offer very compelling propositions in terms of remittance of money, right? Banks are probably the least efficient way to make a low-value payment cross-border. So number one is the cost. Number two is the speed. You saw that Kohli got a notification on his mobile instantly that the money had been credited to him, right? So it wasn't the 3, 4, 5 days that would historically have happened using a telegraphic transfer or a correspondent banking network, right? And number three is perfectly transparent. You know who's paid you, how much, what the currency rate was instantly. So it's perfectly transparent as well, right? Sorry, I like Kohli so much, I thought we'd listen to that again, but I'm just pulling a leg. So we talked about the rise of instant payment networks. We talked about how COVID has accelerated the death of cash really for other payment needs. We talked about the potential usage of card rails in reverse. We talked about cross-border payments and what drives cross-border payments, migration, tourism, e-commerce, trade. Crypto is also a potential disruptor that can make cross-border payments quicker. It can make them cheaper. It can make them more transparent. Ripple is an example of a company that is trying to do this with their own cryptocurrency called XRP. Could you use other cryptocurrencies as a means of exchange for moving money from one place to the other? Potentially, assuming that cryptocurrency has a blockchain network that can handle that volume. I know some people have negative associations with the word crypto, but then I could argue that some people should also have negative associations with the word Hawala, which, right? And I think, for example, right? So I think we need to keep an open mind about some of these newer ways of transferring money. There could be no less evil than some of our older ways of transferring money, to put it bluntly, right? But I won't talk too much about crypto because really we have a resident crypto expert in the family who's Ankur. So Ankur, at this point, I will hand over to you.
Thank you, Deepan. I will also share my screen. So crypto is an ocean unto itself, and I have this very difficult task of covering the basics in a very short period of time. So I have chosen to be as high level as possible. But if there are any questions that remain unanswered, please do ask them. So I think the right place to start is understanding the basics. When we talk about crypto, there are many other terms that come to mind, and they're often used in an interchangeable manner. Distributed ledger, blockchain. Are they the same? Are they different? Let's talk about a distributed ledger. Now, in our typical finance world, we have centralized bookkeeping. In the villages, it was your Muninji. Today, it's the banks, but they own the books, and that's the single point of failure and the only record you have of your transactions. A decentralized ledger is a different view where you have transactions stored across multiple databases, where the databases are owned and managed by different parties. That's what we mean by a distributed ledger. And as a result, for a new transaction to be recorded, it has to be recorded across all the nodes in that distributed system. Then what's a blockchain? A blockchain is nothing but a sequential series of records. and each block is a record or multiple records. Now, when you want to make changes to any aspect of the records in that blockchain, it's not done by editing the data in the blockchain, but you add yet another new block, which has the changes to the information. Blockchains by design are meant to be immutable, and therefore, once data is recorded, you can't change them. Now, all distributed ledgers are not blockchain, and all blockchains do not need to be on a distributed ledger. But when you combine the two together, you get a really powerful system. The other note to call out here is that blockchain is not specific to crypto. Blockchain as a concept is now being adopted across a multitude of industries, including advertising, travel, energy, healthcare, so on and so forth. That brings us to crypto. What is crypto? Think of it as a digital asset that sits on a distributed, decentralized infrastructure. And due to this decentralized infrastructure, it is outside the remit of governments or central authorities. It has intrinsic value because it's self-regulated and self-audited. It's trustless, and by that I mean it doesn't need trust. It's secure. It's a very fast way of transferring value. The transferring of value can be for free or can have a cost depending on the model being used for the crypto blockchain. It, of course, has no physical form and sits on an immutable blockchain. Now, regarding things like supply, it's regulated by the governance that's been set for the crypto. And this is what makes one crypto different from other cryptos, because it's the people who are floating the crypto who define governance. It can be by majority, it can be by quorum. It depends on what the concept is. To give you a sense of how large the crypto market is today, there are more than 7,000 currencies in distribution today. Their market cap is somewhere between $1.72 to $2 trillion. So it's immense. And if anyone here thinks that this is going to disappear, I'm sorry to say that that's not going to happen. Crypto is here to stay. Of the 1.72 trillion, more than $1 trillion is Bitcoin alone, but the rest of the 720 billion comes from the 7,000 plus other cryptocurrencies. I also wanted to introduce a couple of concepts to you regarding crypto. These terms, again, often get thrown up when you talk about cryptocurrency. The first is mining. Often people say it's about solving mathematical problems to create new currency, to create new tokens. But what basically happens in crypto is when a transaction happens on the blockchain, somebody needs to validate it. And when that person validates it, you need to reward that person. So in currencies like Bitcoin, the process of guessing the hashtag that recognizes that transaction is called mining. And if you're the first person to have identified the hashtag that confirms the transaction, you are given a reward, which could be a new Bitcoin. If it's Bitcoin we're talking about, it could be a transaction fee, it could be both. The second is consensus. Now, because a distributed ledger on a blockchain have multiple nodes, when a new transaction is being recorded, it has to be recorded by multiple nodes. Now, those nodes have to agree that the transaction is okay before recording it to the blockchain. That process of agreement is called consensus. Exchange. Now, this is not very different from a stock exchange. It's a centralized platform, typically where you can buy, sell, and trade crypto. They do come in two flavors, though. The centralized ones, which are very similar to our stock exchanges. But you also have decentralized exchanges where there is no centralized agency. There are no order books. It's peer-to-peer. And there's a concept of smart contracts, which I will talk about briefly, which manage the swapping of currencies. Wallet. Now, a wallet is a digital construct where you actually store your currency. Different wallets may be needed for different currencies. And wallets also come in different flavors. You can get a wallet from a third-party provider, and it's your wallet under your control, but you're responsible for its security and its management. But you also get custodial wallets. Now, this is if you've signed up with an exchange and you're buying and selling crypto there, they provide you with the wallet, they manage the security, and they look after all requirements to manage the wallet. A public key, that is pretty much the address of your wallet. So if you want somebody to send you crypto directly in a peer-to-peer manner, like a bank account, you share the public key with them. Private key, this is something that's not visible to you. It's your secret code or your secret hash, which you use to sign off transactions, to confirm transactions. So without that key, you can't transact crypto. A smart contract, as I mentioned, is a programmatic expression of a contract. This is the future of the crypto world. A platform called Ethereum has been championing this, and it's driving the new age of finance called DeFi. And finally, ICO, initial coin offering. This is the crypto equivalent of an IPO. When a new crypto is launched, and they're deciding on liquidity, on supply, on governance, they're required to write out and publish a white paper. That white paper describes exactly the intent, the model for transaction, the model for managing liquidity, and it's on the basis of this that the coin gets listed on an exchange or multiple exchanges and people start buying and transacting. Moving to the most popular flavor of crypto, Bitcoin. Now, this was proposed by an unknown person who went by the name of Satoshi Nakamoto. We don't know much about him. By the name, people guess that he's Japanese, but we don't know that for sure. We don't know if it's a person, if it's a group of people. We don't know whether it's a man or a woman. But this person or this entity published a white paper in 2008 and launched in 2009. It made ripples because it solved two major challenges. And this is what differentiates crypto from digital currencies. Uday Mama will talk about digital currencies, but it's a good time to call out that there is a difference between crypto and digital currencies. Now, what Satoshi was able to do was solve two problems. One was the proof of work challenge, which was how do you encourage people to contribute to this ecosystem and validate transactions that are happening? And how do you reward those people? And number two, how do you solve the problem of double spending? The problem with the digital currency is a digital token is exactly that. It's digital and it could be cloned. And if you don't have a proper governance process, you could spend it in two different places at the same time. So how do you manage that? And that's what Bitcoin was able to resolve. Bitcoin is pseudo-anonymous. So while you don't know who owns the Bitcoins, what you do know is which wallet IDs the Bitcoins are sitting in. And what's remarkable about blockchains are they are visible to the public. So anybody can parse the blockchain and see where money is sitting and how it moves across the blockchain. There is a limited number of Bitcoins by design. It was capped at a total of 21 million. Today, we are at 18.5 million. So we still have a couple of million more to go. On an average, there are about 900 Bitcoins being mined on a daily basis. And of course, the value for Bitcoin is not pegged to any real asset. It's driven purely by supply and demand, and that's what makes it a speculative commodity. There's one other very interesting aspect of Bitcoin, which is the concept of halving. Now, I did say that people who are validating transactions of the Bitcoin and adding new blocks to the blockchain get rewarded. But that reward is getting halved every time something like 210,000 new blocks get added to the blockchain. This makes the number of new coins being generated lower and lower with every subsequent halving. Last year, 2020, we had the third halving, and the next halving is expected to happen in 2024. It goes without saying that every time the rewards are halved, the value of Bitcoins go up because you know that supply is getting tighter. So that's something to keep in mind if you're thinking about investing in Bitcoin. And finally, the other interesting data point is we're expected to see the last halving in 2040. And that's when all the Bitcoins will be mined, the 21 million. Why will people continue to authorize and audit on the blockchain? It's because instead of being given new Bitcoins as with the mining process, they will be paid a fees by people who are transacting on the Bitcoin blockchain. Let's talk about the other kinds of cryptos, the other $720 billion worth. They come in 4 major flavors. The first is the mining based. So I would call many of these clones of Bitcoin. Litecoin is a good example. Ethereum kind of falls under this this umbrella, but it's quite different. As I've said, Ethereum is a platform that has pioneered the concept of smart contracts. It has also become a platform which is being used to launch new cryptocurrencies. And it has also become a platform for launching what are called distributed apps or DApps. And therefore, it's become the first point of entry for the DeFi industry. The second is security. Now, these resemble stock and ownership, and they can either offer you ownership or dividends like shares would. However, unlike the mining-based cryptos, these can come under the purview of various regulatory bodies because this is no different than issuing stocks and shares. Be careful if you are investing in this type of coin. The next is utility. Now, utility works on the principle that the coins that you have bought can be used in turn to purchase some kind of service or commodities. One example is Filecoin. Filecoin is quite popular for being able to help you buy storage space on a distributed system. So rather than your typical cloud storage where you have a OneDrive or a Google, you can actually store files which get distributed across a blockchain, and you pay for that service using the Filecoin. But an easier way to understand utility tokens is airline miles. Now, airline miles, as most of you are aware, can be earned either by flying and in a way that's mining. So as you fly, you're earning miles, or you could buy miles. These miles could then in turn be used to either get to purchase upgrades or to purchase new tickets. So that is pretty much how your utility tokens work. And finally, the new entrant, which are making quite a wave, are stable coins. Now, these coins are pegged in value to other stores of value. It could be fiat currency, it could be gold, it could be other cryptos. And these are becoming very, very popular. Big examples are Tether, USDT, and USD coin. And they have become very, very popular in the use case of transferring money, as an example. International remittance is a really good example. Regulations. So how are governments responding? Now, security tokens, as I've already called out, are under the purview of the FCA, the SEC, and all the other regulatory bodies across the world. They are not forgiving at all if they see that you're trying to sell equivalent of security tokens in the market. Just recently, one of the most well-known cryptos in the industry, Ripple, XRP, which many banks are using for transfers, has been approached and challenged by the SEC, saying that when they raised money in 2013, 2014, it was sold as ownership, as stake, and therefore they're under investigation. Now, many countries have also licensed exchanges, and these exchanges, when licensed, are bound by your standard know your customer and anti-money laundering rules. So often now when you sign up with exchanges because you want to buy and sell crypto, you will have to prove your identity, and they will, like any other bank or financial service, ask for documentation, whether it's your passport or any other documents. And then, of course, governments have gotten wise with capital gains. So a lot of governments are looking at taxing any profits you may make by trading on crypto. The one point I want to make about regulations on crypto is notoriously hard to regulate, especially if you already have the assets. It's close to impossible. What governments can regulate are the entry point and the exit point. The entry point and the exit points are where you convert your regular money, your fiat money, into crypto, or you're doing it the other way around. You're again selling your crypto for real money. And those are the only points right now where the governments can regulate. And that's where they're focusing. Which is why when we talk about DeFi, the distributed finance world, it's going to be even harder for governments because they avoid these entry and exit points. A quick note on how governments, specific governments, are dealing with crypto. There are a surprisingly large number of countries that have become crypto friendly. Australia, Japan are leading the charge. It's legal tender. Countries like Switzerland, EU consider crypto to be property. The Latin American countries are mentioned here because while there is no specific regulation saying they're legal or illegal, there's a heavy adoption of crypto. Venezuela is one of the biggest investors in Bitcoin. And this is because of the unrest that they have had and the challenges they've had with their currency. In Mexico, Chile, you could actually buy products over the counter using crypto. A large number of countries have licensed crypto exchanges and have regulations around crypto, regulations around taxation. And there are very few countries that have outright banned crypto. China, of course, is one. India is on the verge, and Bolivia is another example of a country that has done so. I have not listed here countries that are exploring a central bank digital currency because, as I have said, digital currencies are different from crypto. The point is that they're not regulated. The point is that no particular group has total control over them. But it's worth mentioning that countries like Venezuela, the Bahamas, have already done something. Even the UAE has launched a currency which is not really active, but the foundation exists. And there are other countries like Sweden and China and Estonia who've been looking at launching their own currencies. Crypto is in everyday life. Now, this is happening. It's happening really quick, really fast. As you may know, Visa has just announced that they intend to integrate crypto into their global payment network. They have more than 70 million merchants in the world who are accepting Visa. And if Visa is able to help convert your crypto assets into fiat currency in real time, we are talking about you being able to use your crypto assets to make payments across the globe, across any Visa merchant without any friction. Crypto, as I've already mentioned, has become very effective for transferring money across the borders. USDT, Tether, and USDC, which is called USD Coin, are particularly big players here. Stellar is another one. They peg themselves to a US dollar, so there is no volatility that you are dealing with. Tether claims that they have funds in the bank that actually correspond to all the Tether coins that are in circulation. So at any given time, it's very easy to trade your Tethers back for dollars. USDC is also now being used to pay salaries, especially in the world of crypto. Employees of companies that are working in this space, they are using crypto to pay salaries. And finally, the latest flavor of crypto to hit the market, NFTs, non-fungible tokens. I do want to play this video because this was an unexpected moment in the history of crypto. Sorry.
So we are in my living room and we're watching the closing of the auction, which closes in 1 hour and 18 minutes. It's already at like a absolutely ridiculous amount. The artwork that I made is very much influenced by the tools and influenced by the work of a bunch of people in the crypto community as well.
Hey Mike, this is Jason. I just want to say congratulations. You're at 25,250,000. Crazy, man.
Jesus Christ, what the hell?
Oh my God! 50 million! What? Oh my God!
69 million. I think it probably means digital art is here to stay. I'm going to Disney World.
So just to very quickly talk about NFTs, think of them as digital certificates of ownership for digital assets. Now, the image that this particular artist was talking about, anyone can download off the internet for free. However, there's only one certificate in circulation that identifies an owner. And that certificate sold for $69 million for an image that anyone can download off the internet. And this has taken off a life of its own. The founder of Twitter has just sold the first tweet for a couple of $1 million as well, just by selling an NFT. Anyways, very quickly going into scandals and why you need to be careful. Now, the biggest crypto scandal in the world was put together by a lady by the name of Ruja, and she called herself the crypto queen. The funny thing is, this wasn't even a crypto scandal. It was a multi-level marketing scandal. She claimed she had a new coin, and this coin was going to kill Bitcoin. And she hired an army of salespeople who went and sold for her, who then again hired an army of people who sold for her. She has estimated to have walked away somewhere between $4 billion to $19 billion. And she was only caught because some of the techies, when they started asking for the blockchain so that they could look at the blockchain, couldn't find one because it never existed. Another example is the Twitter hack. Someone hacked Twitter in 2020. Accounts of people like Barack Obama, of the founder of Twitter, of Joe Biden, and then sent out messages to multitudes of people saying, hey, send me Bitcoin to this address and I will double it and contribute to charity. And they had collected a lot of money before they got caught. Stealing in the world of crypto is also not new. About 850,000 tokens were stolen from one of the most well-known exchanges in 2014. The robbery was only worth 500K then, but the heist today is worth 7.5 billion. So one has to be really careful when dealing with crypto. Finally, and this is how I'm ending my presentation, I want to talk about where crypto is going. Now, unfortunately, crypto has been associated with day trading mostly. People think about crypto as a digital asset to trade and make money. However, DeFi, or decentralized financial services, is the direction the crypto world is heading towards. Now, if you combine decentralized infrastructure, a decentralized currency, preferably stable, you can provide decentralized services. There's already a booming marketplace in the DeFi world where you can lend and borrow money. You can do digital asset trading. You can do derivatives trading. You can even apply for insurance. All this without middlemen, all this via smart contracts. Just to give you an idea, there are two very well-known platforms. One is called Dharma for those in America, which allow you to park money, your crypto assets, in this DeFi infrastructure and earn interest of anywhere between 6 to 12%, because smart contracts are used to offer these digital assets as collateral to loans, and you earn interest on that. So in finishing my piece, I would like to say that crypto is here to stay. How you get involved is a very complex question and a conversation unto itself. Thank you.
Thank you very much, Ankur. That was very comprehensive. And now, Uday, you have the last word.
So
sorry for the.
I think no. Look, I think the family, who's still sort of patiently hanging in for the last hour and a half. I really, since 2010, almost 100 new banking terms, technology lingo, fintech lingo, management jargon has all come about. And I think that's partly the reason why this may seem a little too many new phrases and too many things to absorb. So just a few things, and then I will hand it back to Vishubhai. First of all, hello, everybody. And a big hello to my parents who are on the line, my mother and father. But before I start, let me say one thing. I think the nicest thing for me in this FDG has been to get to know Amar, Deepan, and Ankur. I think it's evident from their presentations that these three are doing an absolutely fantastic job in what I consider to be one of the most important transformations that is taking place in the field of economics and money and household consumer choices. So I think all I can say is, after hearing them, I was fully absorbed, mostly absorbed, but I feel that we can be reassured that we are in good hands, regardless of where it all ends. Money is typically a topic on which I personally tread with a lot of professional trepidation. I mean, it is with the peculiar diffidence and even apprehension that I open my mouth on money. I think that's because, as Vishubhai said at the beginning, this is a serious thing. And as Ranubhaiya said, that when he lost all the money with the BCCI's collapse, my God. And I just want to put on, I'm not going to sort of go up and show you all my slides because time is not there, but let me try and put up a few and then hand it back. I hope I can get this right. There you are. Or maybe not. Okay, let's leave this out for a moment. I don't know what is it that I'm not doing right. So I'm going to exit out of that. So the point I was making is that I think that a lot of people say that, why is it that this thing is becoming so popular? And there are three trends that actually have kicked in since 2008, which are driving all the stuff that Ankur, Deepan, and Amar were telling you about. One is, of course, technology. The second is about demographics, which are leading to changes both in wealth accumulation, how many people are becoming wealthy, how is it getting distributed, and so on. And thanks a lot. So yeah, and the third is, of course, technology. And these drivers are leading to what is this new acronym in the 100 that I said is about fintech. But I think the more important thing is, if you go to the slide, Ankur, thanks, this one. I think this is a very important one, right? On a lighter note, I mean, if you look at it, mammals and Homo sapiens and us people with animals, I mean, there's a lot in common, right? We eat, we procreate, we sleep, we care, we love. But there's one thing that distinguishes animals from Homo sapiens, and it is money. And if those of us who have studied economic history for 500 years, of the last 500 years, know that money has been a cause of a lot of disputes and conflict and social disruption. So if Ankur, you go to the next one, what exactly happened in 2008? This is the global financial crisis. I think this is where this whole thing broke and money was back into the center stage because of a massive mistrust that people had with the banking systems. The whole social restiveness came up, that we can't trust our money with banks. That was the time when technology frontiers were also opening up. The whole agenda on financial inclusion came about. And a combination of all that was that, as you heard earlier, that in this pandemic, the usage of cash globally has fallen down very sharply. So people have automatically resorted to a lot of what you might call feeling rich without having actual money or cash in their wallet, because digital forms have come in. And you have heard all kinds of interesting figures from Ankur on the scale of this. Now, if you move to the next one, this just is a quick one to show you how much interest in this CBDC has gone up just in 5 years. I mean, this is a very random thing picked up by somebody from my office in terms of how many times has the term CBDC come about in Google searches, newspapers, and speeches. And there is a spike. And the interesting thing is, if you go to the right side, you see that the spike that has taken place in the lockdown pandemic year. And Ankur, if you move quickly up, further down, please, because I'm going to skip some of them. If you can go on. I think this one here is a testimony. You know, a couple of faces and people, including RBI. I mean, these are whom I call the guardians of the money, global money. I mean, Bank of Japan, US Fed, the European Central Bank, and the RBI. And these, all of them in the last 30 days, so we are talking about something as contemporaneous, have said that either they are introducing or they're researching or they're about to pilot. So at a very, very policy-making level globally, the idea that central banks will not just issue cash and coins, but also live up with times and the kinds of pressure coming from the private industry, move and start thinking about introducing digital form of currency and coins, is going to be a fact of life. My own view is, which is sort of borne out by how I track these things, that by 2023 or 2024, you probably will see that in your global travels, when you're going into a Eurozone or a yen zone or a dollar zone, you will not just be carrying traveler's checks and currency notes. You'll probably have much more of digital wallet that you'll carry. And can you just move up, Ankur, quickly, please? Because a question that often gets asked, go up, please, go up. I want to go to the sand dollar. Well, go up, please. Yes, this one. No, go back. Yep, please. Yep. So this is probably the first digital CBDC that is right now active. And this is in the island of Bahamas. They issued something called the sand dollar. And it was a very interesting thing where the private industry, my MasterCard in this case, came about and worked with the Central Bank of Bahamas to come up with this sand dollar. And sand dollar is very interesting because what the way for you to understand is this person is holding the digital wallet, which is Bahama has dollars, Bahamian dollars, and she's buying a cup of coffee and she's directly debiting her account, which is at the central bank, which is almost like her taking out a dollar bill and paying for a cup of coffee. And what's happening on the other side is that the provider of that cup of coffee is getting that money immediately into her or her bank account. So it's almost like if I give a dollar bill, then the dollar bill goes into the service provider's cash bin. So this is really leading to a dramatic change, and people are watching this. But the bigger news coming, with which I like to close, is the one next to this, Ankur, is China. And if you move to this one, so China is really coming up. They're in a very advanced stage of piloting what they call a digital yuan. And as you know, that the Winter Olympics are taking place in China very soon. And the Chinese are trying to see that actually there is no cash transaction at all when the Olympics take place. So one digital will be the common mode through which renminbi transactions will be done in China by visitors or by the domestics. Now, it doesn't mean that China is abandoning cash and coins, and that's an important point to understand, that the world is moving towards cash, coins, and digital. And I'm talking just about the official side. I'm not talking about the crypto assets and the cryptocurrencies, which is a separate ballgame completely. But you have to imagine as households, as globe-trotting and peripatetic RSD group, that you will have choices. You will have choices. And nobody is talking about either or. I think the world is going to a hybrid system of running with all the three till such time, potentially by the time our Gen 5 grows up and starts earning, that paper-based money is completely passé. But I just want to end with what you should start relating to. And Ankur, please go back to the last slide of the bank branch. Go on. This one. Now, go back, please, to the previous slide. This is typically what you relate a bank branch to be about. I think you should slowly start retiring yourself from this kind of a vision and move to the last slide, Ankur. It's potentially going to be this kind of a world that we are getting into with the backing of central banks and country authorities. So let me pause here. I think that this should summarize a lot. I just want to say one other thing, and Namita raised this point about risks. And I think that's a very, very, very critical part. And that's the reason why when I say that governments and central banks are trying to study, the big thing on the table right now is exactly how the three functions of money that Amar put up, attributes about. One of the big things was it cannot be a store of value with public trust if there are going to be any breakages or cyber attacks or frauds. So one is, we at the policy level, the international community is extremely worried about it. But I think there's enough work going on that seems reassuring. So with that, let me turn it back to you, Vishubhai. I'm sorry, family, this was a very compressed version, but I hope it's got my message out. Thank you.
Yes, it has, Uday. Thank you very much indeed. And all the presentations made by panelists have been excellent, very comprehensive, and congratulations all of you. With respect to crypto and CBDC, I just have a question to ask you, Uday, and also Ankur and Deepan. I do believe that nobody on earth, as they say, can stop an idea whose time has come. And you're right. crypto has probably come here to stay. You can't wish it away. And so also the central bank digital currency. But still, central banks have a mandate, which they pursue, and that is monetary stability. Concern and discomfort of regulators, government, and central banks is arising out of that only, because they don't want to compromise on that mandate. So Uday, as someone who presides over the international monetary systems and financial system, which is under your surveillance, how do you feel crypto or digital will impact on international financial and monetary stability?
I think that's a very very fine question, Vishubhai. That is, when the private industry came in, they came in first. They came in before the CBDC, although Finland and Ecuador had tried to come up with something similar some 15 years back, and which were disasters. But largely the central bank digital currency idea has been propelled by the industry and by demographics. So it is not clear. So a lot will depend. I don't want to make it too technical, but a lot will depend upon the design, Vishubhai, of the central bank digital currency. If it is largely going to be a medium of exchange, then it's much easier than if it is going to become another store of value, where it becomes really money, where monetary aggregates will have to start seeing how to capture them. So the problem that immediately, I think, if I were to take monetary and financial, the bigger problem right now is that what will happen if, suppose, households opt to hold crypto assets, I call them crypto assets, which can be used as a medium of exchange. Then what does the central bank do? I think the first problem will be that there will be a lot of substitution that will take place between bank deposits and crypto. So the central bank, which basically controls money through banking system, will find that there is a lot of intermediation taking out of it, and what type of disclosure and reporting issues will come up. So recognizing what you've said, right now there are 6 central banks, 6 governments who are working together. These are the major currencies, and they are exactly looking into these questions. It is a little premature to say exactly what the steady state will be, but these things have to be ironed out before we start saying that CBDC is going to be a factor.
I am that CBDC would not be a threat to financial stability or monetary policies, monetary systems. But what about crypto?
So crypto is a very big concern. I fully agree with Ankur, but he's right in what he says. But from a policy making point of view, much as crypto is becoming a reality, it is also becoming a very major source or cause of concern on the part of regulators and central banks. For one, because if savings get lost or people's money get lost for any reason, technology, then who is the backstop? There is a backstop when it comes to CBDC, right? CBDC is issued by the RBI, so RBI backstops that. But a private crypto has this problem that there is no backstop. And those arrangements have to be thought through, and there's a lot of discussion going on and trying to sort it out.
Ankur, a related question for you is on this, that if something goes wrong in a crypto transaction, where is the recourse? Who does one go to?
So it's an interesting question you ask. Now, the way cryptocurrency works, it's almost an open book. Like I said, the blockchain is open for all to see. And there have been a couple of publicized issues where due to an error in a smart contract, a particular group of people were able to pull out money which they should not have been able to. And the only way to fix that was that they had to change the blockchain, which is the first rule of blockchain, you don't change it. And that actually eventually led to the demise of that particular currency. So it's not a foolproof concept. That said, the way blockchain works is Bitcoin works, as an example, is very transparent. It's, you know exactly how many assets are available, you know who owns them, you know where they're being transferred to. So about anything going wrong in that particular mechanism, very little can go wrong because of how it's designed. What can go wrong is how those assets are used, or how those assets plug into our regular economic systems. And that is something that is possibly under the control of regulators. And that's why I think certain governments are getting involved and managing that gateway between these crypto ledgers and the fiat currency ledgers. And I think that's the right way to do it, that governments, rather than shying away or trying to ban them, should be more involved in helping set regulations.
No, the jury is still out on this in India, because there is a bill, which is on the anvil, but we don't know whether the intention is to ban crypto or to regulate it in some way. No one is talking about banning. That is not even the title of the bill. But CBDC certainly seems to be on its way, and it's work in process, as the governor himself has said. Now, I have a question for you, Deepan. It was a marvelous presentation that you made on the latest trends in systems. But how is it affecting bank business models, in view of this? I mean, what is happening to retail banking? Are you still going to have brick and mortar branches? Are multinational banks relevant now? Do they need to operate from so many centers?
Understand. So no, I'll try and keep it brief, just conscious of time, but the banking models are changing. In developed, mature markets where you have deep banking penetration, branches are dramatically being cut down. And in Europe, you have open banking, right? Whereby even a fintech can do payment initiation, account information aggregation, right? And access a customer's bank account details and initiate that payment from their accounts. So branches in developed countries will dramatically reduce. India is an exception because, as obviously is a developing country, the RBI has a big mandate to increase branch presence. But I think that is more for the purposes of financial inclusion, right? But if you remove the financial inclusion aspect, I think branches in urban metro affluent areas will probably follow similar to model to developed markets.
Thank you so much. And Amar, finally, for you, I just wanted to ask you, many of our family members sometimes have to handle mutilated notes, notes which cannot be issued, or which are very badly soiled or torn. How does one handle this? Can you just enlighten everyone for this? I think your inputs would be useful.
So basically, we need to distinguish.
And let me say that at some point of time, your Uday Chacha, you and I have handled this work in the claim section of issue department.
Yes.
Of exchanging rotten notes for good notes. Yeah.
I've also officiated as AGM claims where I've seen burnt notes. So
yeah.
So so there are two types of notes really. One is a note that's not damaged; it's really soiled. It's in a very bad, dirty condition, but it's largely undamaged. You can see both the number panels and everything. Now, these kind of notes you can exchange at any bank branch. All banks are required to exchange it, irrespective of whether you hold an account with that bank or not. There's an RBI instruction that requires them to exchange it because we give them good quality notes in exchange for that. So you can walk into any bank branch and say, look, I have these soiled notes. You need to exchange these for me. And they're required to do it. If they don't do it, you have the right to complain to the Reserve Bank that that they've not done it for you. The other part of it is, mutilated notes or cut notes where the note is actually torn. Now here again, This cannot be done at all branches, but all banks have to have certain designated branches where this has to be carried out. Again, you don't need to come all the way to the RBI because RBI is not in all cities and it's not there. You can go to these designated branches. You just need to ask your bank or even your local bank branch which is its designated branch for this. Those designated branches have been delegated the authority to adjudicate on our behalf on these notes. Now, typically, if the note is of a denomination less than rupees 50, if your note is, if more than 80-90% of that note is there, you get full value for it. If it is less than that, you get nothing for it. If it is a denomination that is 50 or more, there you have three things. If less than 80% of it is there, then you get no value. But if you have a little bit more than 80%, then you get half the value. So but basically the idea is that you can go to a designated branch and they will adjudicate it for you. You don't need to come all the way to the RBI for it.
I just wanted to add, just to supplement, that notes are exchanged by Reserve Bank as a matter of grace. It's not a right, because the citizens are expected to handle their currency properly, and if you scribble some political message on a note, then it loses legal tender status. So, or even scribbling on a note with pen or pencil, that may render a note unexchangeable. Yeah, so I think, Ranu, you're probably calling out the time.
There's a question from Gaurav. Gaurav has got his hand up. Gaurav? Gaurav's iPad hand is up, so I don't know whether he had a question.
Bhuvan, he sends me a message that is Bhuvan.
Oh, Bhuvan.
Yes, go ahead,
Bhuvan. Vishu, may I suggest something? Because
Ranu.
There's been a lot of chat and a lot of questions which have been posted.
I think I had requested Suvira to monitor the chat. Suvira, would you like to flag those questions for the panel? Is there time, Ranu?
I was going to suggest that she posts those questions on the FDG group chat, and maybe we can answer those questions on the chat. Otherwise, this will actually go on quite long. And this has been the longest FDG session by a long way.
Well,
thank you. And I hope we have not bored you. It's a heavy topic, although the title was slightly light, and may have sounded funny, but it's a very somber thing to discuss.
No, it isn't. Money is never somber. But anyway.
Ranu Mama, can I ask a question? This is Bhuvan.
Yes, Bhuvan, yes.
Okay, terrific. Thank you for letting me participate in this. This is my first discussion, and I found it fascinating. Now, there are three issues that come to my mind. That there's firstly lack of conceptual clarity between cryptocurrency, blockchain, and digital funding. They're not the same things. So if we talk about them interchangeably, there are lots of issues which come up with that. The second issue is that if we look at modern banking, as Uday Mama was saying, 500 years ago, it started in Italy, in northern Italy, where there were choral associations because of trust. They would lend to each other. And in southern Italy, where you didn't have choral associations, there was this lack of banking because there just wasn't trust there. And that's the problem with cryptocurrency. Because of lack of information and transparency, there is lack of trust. The third point was on regulation. Even if 4 or 5 countries are working on regulation, that's a long way off from having a global framework on regulation for cryptocurrency. And the fifth is security. And this goes back to digital technology and all the problems we face in digital technology, also about privacy versus this, that, and the other, are also applicable to cryptocurrency. So I just wanted to say that while we shouldn't throw the baby out with the bathwater, it is too far away yet to declare this as a wave of the future.
Bhuvan, that was very appropriate comments. I didn't see a question there, but very, very appropriate comments. You know, Bhuvan, it's great to have you here for the first time in FDG. May I suggest that you join the chat group, because this is the 15th session and we've had some great topics. So I hope to see you in these sessions every fortnight from now on, okay?
Ranu Mama, I hardly ever get up at 8:30, but I do listen to them diligently.
Okay, all right, all right. So listen, Vishu, with your permission, I think if I could suggest that we answer these questions, ask the questions and answer them.
Sure, sure.
The chat group, because then it can be much more explanation can be given. Before we end, as I normally do, I just want to say that this is the third last session of FTG in season 1. Okay, so there will be a break of 4 months when we will start season 2 again, which will be at the end of August. I think a little bit of break will create some anticipation. I have to say that this has been a hugely successful family enterprise, joint enterprise that has, I have learned a lot, and I'm from everything I hear, it has been found very useful. So we will have only 2 sessions after this. Normally I announce 3 sessions. And the first session after this will be led by Chand, which will be the resurgent private sector. Well, finally, the private sector is very respectable in India. It took a long time coming, but finally we are respectable. And this is on the 4th of April, which will be led by Chand. And then on the 18th of April, there will be a session that will be led by Madhur, which will be on ecosystem restoration. And that will be on the 18th of April. And after that, we will take a break from FDG for 4 months. And we will start again at the end of August. I think this break is necessary, so you have to wait for it. And that will be the second season will start, and we'll have another 18 episodes going through to next April or May. Okay, so this is thank you so much, and I will do a analysis of who all have participated in season 1 at the end of it, which means what has been the gender parity, what has been the generation parity, what have been the topics, and what has been the length. And I'll also create a folder where the links to all the sessions for season 1 will be available for your watching if you miss us during the 4 months that we are not there. Okay. Okay. So
great. Thank you very much for your
Bye-bye.
patience.
Thank you so much.
Bye, everybody.
Great session, by the way. Great session. Great session.
Thank you, Ranu.
Thank you. Thank you, Ranu. Thank you so much.
Thank you.